Are you constantly losing trades on gold even though your strategy seems solid? It's probably not the strategy, it's the mistakes.
Don't cry, don't cry, don't cry, don't cry, don't cry. Don't cry.
In this video, I'll show you the 7 most common mistakes traders make trading XAUUSD and how we can fix those mistakes today. Guys, make sure to stick around to the very end of the video. We have a very special offer for you, those who would like to get involved in the A.C.T Forex VIP. Let's get into the video, guys. Alright guys, so mistake number 1 is a very common mistake I see traders make, and that is simply trading into consolidation. As we can see in these examples, guys, gold ranges tightly. If candles are small and wicks are everywhere, we need to simply wait. From my personal experience, gold will pay the patient trader, so we just simply need to wait and let it choose direction. So if we patiently wait and let it create the first move, we can then look to pick up the pieces. So we can just see here on the gold, for instance, after a period of consolidation, it makes a move up to a previous level of resistance. At that point, it's our cue to start to look for our potential price action catalyst to sell it. We have rejection just here on this candle, followed by weak bullish closure. Entry could have been taken as price began to break the low of that bullish candle. So this is again just a clear sign as to what is best to do after a period of consolidation. Just simply wait for it to create the move, get to a potential level of interest, and then look out for your candle catalyst. That is mistake number 1. Mistake number 2, guys, and I must put my hand up because I fall for this mistake sometimes myself, and that is ignoring session timing. The main thing I mean by that is gold will tend to behave a little bit differently at the open of a session, whether that be the very open of the Tokyo session, the very first candle, very first open, the candle open of London session, or the NY session. Likely what's going to happen is price is going to be a little bit more volatile for that particular candle itself. It may look like it's about to make a move very quickly into the candle, and then it pulls all the way back in the opposite direction. So a way to fix that is to simply let it do its thing. So let it play out the first minute or two. For instance, if we're looking for a wick to form and we've not yet got it, so let's just say we're looking for a self and a resistance here, and price just begins to drop. Sometimes what we do is, well, what I do is, as long as it's got a little bit of an upper wick, I tend to jump in maybe a little bit too quickly. So this is again an error on my part as well sometimes. So let's just say we had this sort of closure prior to it, like so, and I wanted to take a sell from below the support. Sometimes I jump the gun and get in a bit early in the first minute or so without really creating more of an upper wick. So in this sort of circumstance, what I would suggest in order to fix this is simply let it do its thing, let it play its part in the first few minutes of the session open. Make sure if you want that wick in the opposite direction, so for instance, if it begins to drop, you've only got a tiny low wick, just ask yourself, it's very early into the session, there's going to be a lot of volatility about. It's a good chance it's going to pull back up to create more of an upper wick, and maybe you could say to yourself, if it doesn't tap into the high of the resistance or create a deeper upper wick, then I'm just simply going to let it play out and do its thing, reassess and see what other options I may come up with. So that is a mistake that I've fallen for a few times. I admit it, and that's something that, you know, it can be easily fixed. So just give yourself maybe the first few minutes at session open, maybe the first 5 minutes to play out, and then you can look to execute your trades if you have the right confirmation to do so. Now, mistake number 3 is chasing gold after big moves, and this is the dreaded FOMO, guys. I admit it, I used to fall for it years and years ago, but why I don't anymore is because I have a very simple plan and some rules that I follow very, very strictly. So guys, what you need to realize is gold will make these moves, and sometimes you're not in it. So what you need to do is not chase it. So you got to ask yourself, first of all, where are we on the charts? If gold has come from the highs and you're looking to get involved below, for instance, this support here, you got to look at it and think, well, maybe you're a little bit too late to the party. That's some, for instance, 400 plus pips after the move. So ask yourself where we've come from. If it's made already a bit of an impulse, you need to reassess again, and you need to come up with a new game plan as to how you're going to get involved, and just simply wait. So a way to fix that as well is, if you come to charts and you see it make a move, don't just jump in. If you've got to, you obviously need to reassess. It may be best to walk away for at least half an hour. Now come back if you feel like you're going to do something impulsive. That's what I mean. So come back a little bit later, see where the charts are at, and maybe it's reset to give you a potential. Mistake number 4. Now this is a little bit subjective. It's drawing levels incorrectly, and everyone has a different way to draw in their levels of support and resistance. Did a video recently, just recorded a video recently and uploaded about drawing support and resistance. Some will just use horizontals. I do it a little bit differently. I like to use my zones because what I tend to see is price taps into these levels quite often. So once again, I could draw it up here just quickly. If you're looking at the 4 hour, I'd use that as the most recent resistance. I'd include this bearish wick for the time being as the most recent support. Even though we'll have to adjust in the M15 just to ensure it is the lowest point of a bullish candle, we need to ensure it's the highest point of a bearish candle in the M15 and adjust accordingly. So we just adjust it to this point here. You can keep the zone deep, so we know it's the 4 hour level. The downside here, we could adjust it to this point here. Once again, you could keep it in deep, knowing roughly that this is going to be the tap in for the 4 hour level at support, and this is going to be the tap in 4 hour resistance at the resistance. By having these levels marked in, I know exactly where we are in regards to the range. What we can see is right now, you could divide your range into thirds, and this is just roughly what that would look like. So for instance here, ideally you want to get involved in a sell from the top third. Ideally, doesn't mean I would not sell it in the middle third, and sometimes if I've got the margin, I'll consider selling it in the bottom third. But again, you got to ask yourself where you are. So mark in your levels so you know roughly where you are. Minor supports, I'd mark in just here. So that to me is a level of interest that price could potentially pull back to. We've also just recently had a level of interest that we have just broken through. Could also mark that level in, and we'll look for potential sell below upon a closure. This happens to be market close, so charts aren't open, trading at the moment on gold. So again, this to me, these levels, if you mark them incorrectly, what it's going to do is give you not only a cue to enter, but in my opinion, it's going to give you the cue to enter at the right level on the chart. So again, we can see here on gold, we're in a downtrend. We have retested a previous zone multiple times. So what we could be doing just now is pulling back to create a lower high. By marking in this zone of support, I know that if price was to close below it, pull back to retest it in the following candle, begin to break below the catalyst candle's low, just here, then that is there's a high probability what we're going to come back down to is the next level of support. On to mistake number 5, and I must admit as well, I do sometimes fall for this. I'm just full transparency, being honest, and that is having your stop loss placed a little bit too tightly. So we're going to use this as the example here. We're going to look at a potential short position on the gold. So generally speaking, as you guys know, technical level for me will be above the catalyst candle's high if I'm looking for a sell, the catalyst candle's low if I'm looking for a buy. Sometimes what is going to happen is because I'm scalping, I'm only looking for small movements or more increments in the market, so maybe that 20 plus pip move. Sometimes what's going to happen is the stop loss based off the catalyst candle is going to be a little bit too wide. So if we're pushing 60, 70, look, at most part, because the more volume on gold recently, you're pushing 80 plus, then I'm likely going to have to use the entry candle. So what that's going to mean is, I'm just draw it up. So I'm going to wait for the following candle to create its upper wick. It may not create that big of an upper wick. It may not necessarily retest that previous zone. So that would be the retest in accordance to the way I see it. That is the candle form support, this bullish candle. So if again stop loss is too wide based off the previous catalyst candle, that is sometimes what I'll look for is to place the stop loss just below the entry candle. So that would roughly look like so, and then what happens is price triggers you in. At that point you've got what, roughly about a 20 pip stop, roughly just under 20 pip stop. So what happens tends to happen, price would tag you in after creating a bit of an upper wick, and then it tends to, it looks like you're about to head down, and then my pullback is not quite ready, taps into that zone, tags you out, and then drops. And that sometimes happens. So a good way to fix that, way of avoiding that, guys, is just to simply be a little bit more patient. If the stop loss is too wide based above the catalyst candle, then what we need to wait for is just wait for it to patiently pull back to tap into the level. Because again, it's not foolproof. It doesn't mean it's 100% probability, but if we retest and begin to pull away and it begins to pop below to trigger us into the trade, we know at that point there's a much higher probability of it making the move down, and a stop loss should be, well, for the most part, the stop loss would be quite safe back above the entry candle's high. So that would be a good way to avoid that mistake of having your stop loss placed a little too tightly. So mistake number 6 and 7 kind of tie into one another, guys, and mistake number 6 is trading without a plan. So no matter what the asset class is, guys, you need to have a solid trading plan, and that trading plan needs to outline things such as, first of all, what you are trading, also what you're going to be willing to risk per trade. I don't recommend more than maybe 2% max, 1 to 2%. How many trades of a day you're going to be taking, and just a general plan as to what you are to do when you are to come to the chart. So obviously, first of all, you are to mark up your charts, do your analysis, obviously wait for price to then move to a level of interest, and then ask yourself what you want to see at that particular level of interest, and then just patiently wait for it to present. Now, the final mistake, number 7, and thank you to those who have watched this far. The final mistake is trading without rules. So once we have done our plan, we need to create some rules. So what I mean by that is when price moves to a potential level of interest, what do we ask? We need to ask ourselves, what do we want to see in order to execute a trade? So let's just use this as the example. The market is just literally open right now while I'm recording this. So I could have said to myself prior to it, I wanted to see this candle closing strong bearish engulfing below the support. Let's just say it's at a level of interest. If I predetermined this to be a level that I'd like to get involved in a trade for whatever reason, it could be a resistance, just could be a general level of interest that I have predetermined to be, you know, a good level to get involved, and said I want the bearish engulfing below. I've ticked that off, and then I can look to execute upon the trade. A lot of traders will, again, similar to mistake number 6, will just literally come to the charts and say, right, gold looks like it's going to melt, not done my analysis, have no rules that I'm following, I'm just going to take the trade. Or again, rules such as, for me, a very important rule prior to any entry, irrespective of whether it's a buy, sell, irrespective of whether it's a breakout, zone to zone, sell from resistance, buy from support, so on and so forth. One key rule for me is I must have an upper wick prior to the entry if it's looking for a sell, and I must have a low wick prior to an entry if I am looking for a potential buy. Because just generally speaking, if you are to look to the left on the charts, you're going to see that 95+% of these candles will have wicks in both directions. So that's just one example, but you need to have a solid set of rules to follow before you are to take any trade. Ask yourself what you want to see, stick to that plan, because trust me, if you've done your homework and put in the time and effort, it's of much higher probability that you're going to be on the right side of things than not. So that is mistake number 7. So once again, guys, thank you to everyone who has stuck around to the very end of this video. Don't forget, if it has helped you out in any way, drop a like and subscribe to the channel. Come watch me trade live from Monday to Friday, pre-London into London Open. Now, I have a very special offer for my loyal viewers. For those who are interested in joining the Discord VIP, where you will gain access to the full course, all the other educational content, regular live members only calls between 3 and 5 days of a week. I have a very special promo code for you, and I'll drop that in the description below with the link to the VIP. Guys, I'll see you on live streams, and I'll see you in the VIP. Cheers, my friends. Bye, guys.